Now, at this level, is it's quite safe to say that we all can get a basic setup. We all can mark out a trade that has to do with reversals, or we can mark a trade that has to do with continuations. It's quite safe to say that now, because with what has been taught, I'm very, very sure that we can all identify a proper structure shift. We can all identify a proper multiple record structure. We can all identify a proper inducement. And using the rules of picking a proper point of interest, we can all identify the right POI to choose. And that is the most important. That's one of the most important things that has to do with anything of this strategy. First of all, you have to understand how to pick your entry as well. So that is very, very, very important. So we already have an idea of what we should look out for when we're dealing with the normal day-to-day, step-by-step activities that we do before we pick an entry on our trade. Observe the bias of the market, get the structure of the market to know whether we're looking for continuations or reversals. And after that, we look out for the rules of picking a proper point of interest, and then we look for our POI and choose it. Now, that is already, like I would say, the main thing that you need to do on the market. But after that, in as much as your entry is important on the chart, your exit is also important as well. Hope you guys can hear me, right? So, 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 sorry, I'm a little bit weak. So, the normal concepts that we look out for, if it's reversals, we're looking for um price giving us a market structure sheet, inducement, our POI. If it's continuations, we're also looking for market giving us multiple record structure, inducement, and our POI. So that's the normal ideology to picking our entries in terms of this strategy. So after that, the next thing that you're supposed to do is weigh. In as much as your entry is important, your exit is also important as well. Wherever you place your entry is important. The place you place your exit is also important because how many times have you guys faced this issue of being on a trade, being up in massive profits, price hitting a zone, and then because you're waiting for more profits, market will eventually reverse and hit your stop loss. It's happened to multiple people countless times. That they don't really understand the zones to place their take profit levels in the market in regards to this particular strategy. In as much as we get into the market with liquidity, we also get out of the market with liquidity as well. So we trade liquidity-based systems for both entries and exits as well, just to avoid issues like you taking a trade, being in good profit, and then eventually price hitting your stop loss and taking you out. So if you understand the zones that liquidity lays in the market, you will not have issues with this kind of things. So first of all, hope you guys are following me up. So that is going to be our class for today. Different types of liquidity and how we take our profits in the market using those types of liquidity. So we're going to talk about the types of liquidity that we have in the market and how you can spot liquidity to be able to avoid markets using you as one, to be able to avoid you getting to the market early when liquidity is still at the process of being cleared. That's what we're going to talk about today. And with that, you also know where to place your take profit levels in regards to the in regards to the to what you trade and in regards to the type of liquidity concept that shows up on the chart for you. So now let's talk about the first type of liquidity, which is very, very, very common on the chart. One of the most common types of liquidity that you see have in the market is called trend line liquidity. Why is it very common? It's very common because most times market is always in transit. If market is making its movements, whether it's trending to the upside or it's trending to the downside, it's always going towards exhibit liquidity, like trending patterns. If market is bullish, it's going to be giving you a series of higher highs and higher lows, right? That higher highs and higher lows that is giving you is exhibiting what? An uptrend. That means for each trend of the markets that exists, there's going to be trend line liquidity on that trend. So as market is bullish, there will be trend line liquidity for the bullish market. And the market is also bearish, there will also be trend line liquidity for the bearish market as well. So the market, why? Because majority of the time, market is always moving. So because market is mostly always moving, it's going to be the trend line is going to be very, very common and very rampant on the chart, simply because market is mostly always moving. If you open up your chart and it's trending to the upside, while it's trending to the upside, just know that there's trend line liquidity being accumulated during that process. If market is trending to the downside, just know that there's trend line liquidity being accumulated during that process. So this buy that you see here now, this higher high and higher low, this uptrend, there's trend line liquidity being accumulated here. This downtrend, there's trend line liquidity being accumulated here. This downtrend, there's trend line liquidity being accumulated there. So whenever you see markets in transit making a movement from either one zone to another and it's trending, just know that there's trend line liquidity being accumulated on that particular chart. Hope you guys are following me up. So that is one of the most common types of liquidity that we have in the market. Trend line liquidity is one of the most common types of liquidity that we have in the market. So how do we use trend line liquidity? First of all, when you have market on a particular trend, just know that there's trend line liquidity being accumulated on the opposite sides of the trend. For example, if you have a downtrend that consists of market giving us a series of lower high and lower low, lower high and lower low, lower high and lower low, lower high and lower low. While this downtrend is happening, just know that there's trend line liquidity being accumulated on the upside of this chart. Wherever market is trending at, the trend line liquidity will be accumulated on the opposite side of the chart. So as we have this downtrend, the trend line liquidity will be accumulated on the upside of this downtrend, meaning that the trend line liquidity will be laid up here. And if you have a downtrend, if you have an uptrend, which is consisting of a series of higher high and higher low, higher high and higher low, higher high and higher low, higher high and higher low. Just know that while this is happening, there is trend line liquidity being accumulated on the upside of this trend. So on the downside of it. So whichever direction that the market is trending at, the trend line liquidity is being accumulated on the opposite sides of the chart. So we have this downtrend. It means that the trend line liquidity will be accumulated on the upside of the chart here. Liquidity basically means the zones in the market where there is money. Liquidity means money, where price might be likely interested in going to. So when you know where market is likely interested to go to, that means you can take your trade and take your profit at those zones where market is most likely interested to approach. So if you also have this uptrend, that means that there's trend line liquidity being accumulated on the downside of this chart here, meaning that the trend line liquidity for this chart is down here where this uptrend started from. And this one will be up here where the downtrend started from. So this is one of the most common types of liquidity we have in the market. So for example, this is what a downtrend, which consists of a series of lower high and lower low, lower high and lower low, lower high and lower low, lower high and lower low. So this is a downtrend, right? What does that mean? It means that there's trend line liquidity being accumulated on the upside of this downtrend here. That's what it means. It means that there's trend line liquidity being accumulated on the upside of this downtrend here. So wherever you see markets on a particular trend, just know there's trend line liquidity being accumulated on the opposite sides of that trend the market is on. Same way, you see this downtrend here. This lower high and lower lows makes up a downtrend. What this means is that there's what trendline liquidity being accumulated on the upside of this chart here. That's what it means. So whichever direction you see markets trending at, just know that there's trendline liquidity being accumulated on the opposite side of that trend. That is one of the most common types of liquidity, which is trendline liquidity, because most times market is always mostly trending. So now you can incorporate this to your take profit levels, because since market is always mostly moving, it means that even when market wants to approach your points of interest, or market is moving from your point of interest to any direction, it's going to still be giving you these liquidity type patterns. What does this mean? It means you can incorporate the different types of liquidity that exist in the market at your take profit levels. What do I mean by this? Now, first of all, you know that there are different types of structures that we trade in the market. The different concepts that we trade structures with is called the concept of reversals and the concept of what continuations, which means we can use both. We can trade the market with either one of these two. Most times, we're always looking for continuations, and the reversals is just once in a while. But the ways that we approach our market for the take profit levels of these two concepts is a little bit different, but it's using the same concepts. Now let's talk about the most common types of liquidity that we have in the market and how we can take our profit when it comes to reversal concepts. Now, for reversal concepts to exist, market needs to have a previously existing trend before you can have a reversal of that previous trend. If you have an uptrend previously existing, that means for there to be a reversal concept, market needs to change from that previous uptrend to now a downtrend. And if you have a previous existing downtrend, for that to be a reversal concept, market needs to change from that downtrend to a current uptrend. Something like this. For that to be a reversal concept, market needs to what? Take out this high, right? To be a proper MSS, to make this a bullish market, right? And for this particular one to have a reversal concept, market needs to also do this, take out this low and change the market direction from this uptrend to a downtrend for it to become bearish. That means for every reversal concept that's needed, you have previous existing trends. Before market will change directions to a new direction, there needs to be a previous direction for it to change trend from. So that is the thing with reversal concepts. And you know that we try reversal concepts few times, but the thing is that we still need the different types of liquidity that exist in the market if you want to properly take your profit in the market when it comes to dealing with these reversal concept trades. So what do I mean by that? So first of all, like I said, there are different types of liquidity that exist in the market, and the most common type is called trendline liquidity. And I said that trendline liquidity is basically the liquidity that is being formed when market is on a particular trend and at the opposite side of the trend. If you have a downtrend, that means that there's trendline liquidity being accumulated on the upside of your chart. And if you have an uptrend, that means that there's trendline liquidity being accumulated on the downside of your chart. So, like I said, we have two different concepts that we trade market structure with. It means for each of these concepts, we also need to take our profit in the market for either one of these two concepts. Whether you're looking for reversals in the market or you're looking for continuations in the market, you still need to be able to take your profit in the market, regardless of whichever concept that shows up in the market. So we're going to talk about reversal concept first, and it's quite easy to take our profit in the market using reversal concept trades. Why? Because why it's easy is because there are previous existing trends in the market before. There are previous existing structures in the market before that you can target as a take profit level for anything related to reversal concept trades. Are you guys following me up? So why is easier to target why is easier to target the take profit level for reversal kind of trades is because there are previous existing structures. There are previous existing structures, so it's easier to know where to place your take profit because you can easily see previous structures in the market to direct you on where to place your take profit levels. But for continuation entries, you mostly have to depend on new structures being formed for you to take your profit in the market. What do I mean by that? Before market will give you a reversal concept, yeah, this is a previous downtrend. I got a reversal concept to the upside here. Now, before this happened, you see that there were previous structures, a previous downtrend. What does that mean? you can use these previous structures existing in the market to know where and where to place your take profit level, right? But if something like this happens, let's say you get like a continuation entry and then you get an inducement and the market pushes to the upside. At this level, there are no previous structures that you can target for your take profit level, meaning that you have to depend on new structures being formed before you can look for places to now put your take profit level if you eventually take your trade from the next POI. So for reversal concept, it's easier because there are previous structures that you can target for your take profit level. For continuation entries is harder. It's not really hard, but it's different because you have to rely on new structures being formed before you can now place your take profit level correctly. So that's why it's a bit different to take profit in the market using either one of these two concepts, reversal concept and continuation concept. But trust me, you can apply the same type of liquidity TP to either one of these two. So how do we take our profit in the market when we're dealing with what? When we're dealing with reversal concept trades. So first of all, how do we take our profit in the market when we're dealing with reversal concept trades? The first thing to pay attention to is what the particular trend the market was previously on and where the trend started from or where the trend originated from. I'm going to use gold because I've not really had a proper trade based on reversals that lasted for an extensive period of time. Oh, let me see this one. Oh, let's use this for example. Let's use this one. So this is an example of a reversal concept trade because you have market on a particular trend for an extensive period of time, right? Before we got the reversal concept here, and then we got price pull back into this breaker block for this sale to happen. Now, what do you notice? Before market gave us a reversal concept, we had market on a particular trend previously, which is the previous uptrend. That means for there to be a reversal concept, markets need to deviate from the pattern of this previous trend. And when market gave us a reversal concept here, that was when you got it. I'm trying to tell you how you can take your profit in the market when you're dealing with reversal concepts. Now, like I said, when talking about when talking about reversal concept trades, it's easier to pick a take profit level because there are previous structures existing in the market. And like I said, there are only two types of trends in the market. There's only the uptrend and there's only the downtrend. Meaning that it's quite easy to tell whether you're looking for reversals for a sell or whether you're looking for reversals for a buy. Whichever trend the market is currently on, that you get a reversal concept from. That means you're going to trade the opposite direction of the market. So let's say you have a previous uptrend for an extensive period of time. Let's say the auction has been happening for like a day, 2 days, 3 days, because most times they actually tend to happen for a long period of time. Let's say for 3 days, you've had an uptrend, a series of higher high and a series of higher low, a series of higher high, a series of higher low, a series of higher high, a series of higher low, a series of higher high, a series of higher low. Then when we talk about directional bias, you guys understand the zones I'm talking about for reversal. On a daily time frame, let's assume that you have a zone meant to reverse the market direction up here. When we talk about directional bias, talk about these zones. Now, market slowly maintains the uptrend while approaching this level I'm talking about. Higher high, higher low, higher high, higher low. Then it triggers that zone that we're expecting the reversal to come in. And after it triggers the zone, it gives us a reversal concept trade. Because for reversal concepts, market does not just reverse anywhere, it touches higher time frame points of interest. Before market can give you a reversal concept, it needs to touch a zone on the higher time frame, which we're going to talk about in the directional bias class. That's when we're going to talk about it. So when market hits this zone, expect a reversal to come in or for price to continue the trend. If market should continue this higher high and higher low to break this zone, that means that the trend is not going to reverse. But if market should hit this zone and give you a reversal concept, which is what a market structure shift, that means market is about to change directions from this uptrend to a downtrend. Now that is one of the things that you need. After that, following your strategy, you get your inducement and you get the right point of interest to pick your entries. First time reversals are mostly always tricky to pick out. Most times you may not be on the right time frame to spot the inducement. Sometimes you may not be on the right time frame to spot the right POI and the rest. The market may leave you behind. But once you realize that it has already happened, find a way to join into the market by using for continuation entries. Now, when market hits this zone, it will give you a reversal concept And then with the rules of picking a point of interest, if you have an inducement here, your POI will likely be at this breaker block here. Picking the entries is not difficult for us. We already understand our rules. We understand step-by-step process of how to actually identify our zones and pick it, depending on what market shows up. A lot of people have been sending me their charts. I've been seeing their work, and it's very, very nice. For people that are still having a bit of difficulties, you can always stick to it and practice harder. There's no late time for you to understand. So, with the root of picking a point of interest, this is our inducement. Our PI will be the PI closest to the inducement, which should be the breaker block that exists here. So, this is something that we already have down on how to pick our entries. Now that we've picked our entry, the next thing on our mind will now be where do we place our take profit for this particular trade that we took. Now, remember, take profit may not hit once, it might take days because this uptrend probably took days to form. So, the take profit level may also take days to form as well. The thing I'm trying to make you understand is to know where market is heading to. So even if you take the first trade and you don't hold it all the way to the overall TP, the next day you wake up or the next day you want to analyze, you can literally look for continuation entries to still target the overall TP of that market. I'll show you guys an example of this on gold, where market one price action was extremely sweet, extremely very, very sweet. But now, if you find your nearest zone liquidity, you run. But so what I mean is that when market gives that reversal concept, the next thing that will come to your mind is what? Where am I going to place my take profit for this trade? That is where the different types of liquidity that markets we have in the market comes in play. So, like I said, when you have market on a particular trend, that is trend line liquidity being accumulated on the opposite side of that chart. What does this mean? It means that the moment market peak was on an uptrend, when it maintained this uptrend, there will be trend line liquidity being accumulated on the what? On the downside of this uptrend, meaning that this whole downside here, there's trend line liquidity being accumulated on the downside of this chart here. Now it has to connect seamlessly. You don't have to force it. If the trend has happened like this before, let's say something like this, then it fell down here and it started pushing back up. You can't start adding this zone here because it does not connect seamlessly. You have to make sure it connects well without you having to force it. So the ones that does not, you don't have to add it to the trend line liquidity, but the ones that do, add it. So that means that we have this trend line liquidity here. And since we have this trend line liquidity here, it means that this trend originated from down here because that's the one we can actually connect well. It means that our trend line liquidity is this particular downside of the chart till this zone that the uptrend started from. What this means is that the moment market gives you a structure shift and is ready to sell to the downside, for there to be a proper sweep of liquidity, markets need to sell until they clear this entire trend line liquidity that market was accumulating while it was on this uptrend. Now, while I don't know if you guys are following up what I'm teaching, am I confusing you guys? What I'm explaining to you guys is that when you have market on a particular trend for an extensive period of time, if it's an uptrend, just know that there's trend line liquidity being accumulated on the downside of that uptrend. If it's a downtrend, just know that there's trend line liquidity being accumulated on the upside of that downtrend. Whichever direction the market is trending at, there's trend line liquidity being accumulated on the opposite sides of the trend. So if you have this uptrend right here, it means that there's trend line liquidity being accumulated on the downside of this uptrend, meaning that the trend line liquidity will be where this trend originated from, down here. Right? And then if you have this previous downtrend, it means that there's trend line liquidity on this zone that the downtrend originated from, which means this upside here. So what I'm trying to explain is that for whichever trend the market is on, just know that there's trendline liquidity being accumulated on the opposite sides of that trend. If you have an uptrend, there's trendline liquidity being accumulated on the downside. If you have a downtrend, the trendline liquidity will be on the upside. Whichever trend the market is on, the trendline liquidity is on the opposite side of that trend. I want to have as a clean example on gold that I used last year. I want to use for you guys. I'll clear that's for reversal concepts because most times, well, you can see it here as well. You can see it here again. This is it. We have this uptrend on gold, right? Our market was maintaining this uptrend. You can see this is the one that connects without me forcing it. I didn't try to include these ones here because it doesn't really connect seamlessly. This is the one that connects well without me forcing it. That means that there's trendline liquidity being accumulated on the downside of this particular uptrend that gold was maintaining. The moment that price becomes bearish and it wants to sell, it will sell and is attracted to this zone that uptrend originated from. That was why you see when this sale happened, price took out that entire trend line liquidity. But let's talk about, let me look for one that's very, very, very clean so I can explain this to you guys. So whenever you see it on the chart, you can be able to recognize it and know how to trade it as well. So first things first, you need to identify the particular trend that market is on, right? So if you check this particular trend, you can tell that gold was bullish, giving us a series of higher highs, higher low, higher high, 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 higher low, higher high. Then this sell gave us a lower low, meaning that there was a market structure shift at this level, meaning that this is the point where market is supposed to give us a reversal. There's a POID on the higher time frames, which I said that we'll talk about in directional bias class. And we got a reversal concept here being a market structure shift when this low was taken out and this huge impulsive sell happened. After that, this is what our market structure shifts, right? After the market structure shift happens, you have to mark out your possible points of interest. So the zones that price took out for our MSS to be created will become our breaker. So this is our breaker block here. This is also another breaker block here, the body of this low, and then up here is our other block. So we have about 1, 2, and 3 points of interest. That's what I taught you guys. After that, the next rule is to look out for your inducement. This pullback that we had here before price continue pushing to the downside becomes our inducement. Now, the third rule says the point of interest needs to be unmitigated. When this particular pullback happened, it touched this particular breaker block down here. Therefore, it's disqualifying this breaker because it got mitigated by this inducement candle, leaving just this breaker block here and the other block here. The last rule says pick the point of interest closest to your inducement. So if you're tracing it from the inducement, the PI you're going to meet first is what? This breaker block here. That's why the sell happened from there, right? So that's why the sale happened from there. So we've already picked out the right entry. Hope you guys understand how I was able to get this. You guys understand this particular analysis I made now, right? You guys understand this analysis? So we've already marked out our POI. Good and fine. The next thing should be, where am I going to place my take profit level? That's the next question. You understand? That's the next question. Where am I going to place my take profit level? That's where you now consider this type of liquidity. So first of all, we had a previous uptrend. What does that mean? It means that because we have this uptrend, what does it mean? It means that there's trendline liquidity being accumulated where? We had this previous uptrend. Where was the trendline liquidity being accumulated? The question is for you guys. We had a previous uptrend. Where is the trendline liquidity being accumulated at? What I mean is, yes, on the downside of the uptrend, that is where the trendline liquidity is being accumulated. So that means we have, now you have to look at it and connect it well. So this is the one that connects without us having to stress it. You can't include this because the market go to this zone, it drops to the downside, and it's not really a nice connection. So what I'm going to target is what? The one that connects seamlessly without me having to stress it, without me having to do a lot of configurations to drawing the trend line. So when I draw this, it means that the trend originated from down here, because that was where the higher highs and higher lows started, all the way down to 3226, 3225. That means for me to take this trade, I'm going to be bearish until price takes out this trend line liquidity that it was accumulating while market was maintaining this particular uptrend. Now, most people may not be able to hold the trade to hit this full zone. That is why you can target closed zones and then still find a way to join in the market with continuations until price successfully takes out the entire trendline liquidity. Now, once you've understood that price is heading to clear this trendline liquidity, instead of opposing the market directions, I suggest that you look for more entries, to look for more trades, to take in the direction of where the trendline liquidity is until price successfully clears it. This is what I mean. This is the first trade, right? So you can either hold this trade all the way down to TP, but if you don't have the mind to do that, you can take your profit at the nearest zone, which can be this low or any of these zones here, and still find a way to join into the market later by using continuation entries. What do I mean by continuation entries? I mean the multiple breakout structure when price took out this low and took out this low here as well, and took out this low here as well. That is the multiple breakout structure. After that, we got the pullback here, which acts as our inducement, and nearest point of interest being our breaker block here. This is where we took a second sell from. So anyone that missed this first entry for reversals can also get the second entry for continuation and still trade it all the way down till price successfully clears this trend line liquidity. Now there's a mistake that most people make on the chart. They have a setup like this and then they start opposing it. This is what I mean. We already know that market is bearish, right? And then for our TP, we already marked out the trend line liquidity that price should clear for our TP to be valid. Now, you already have that trend line liquidity marked out, and market has not yet cleared that trend line liquidity. Then you start buying from points of interest that is enclosed inside of that trend line liquidity. Why, Ebuka? Ebuka, why? This is what I mean. You have an uptrend, right? You get a reversal concept that tells you that a sell is going to happen soon. Now, after that, you start selling the market and your TP is targeted to clear trendline liquidity. Market is still at the process of clearing trendline liquidity, and you start buying using points of interest that exist inside of the trendline liquidity. You start looking for buys from an order block here, or a breaker block here, or an order block here. Why? Why? You're literally taking trades inside of a liquidity pool. Liquidity pool basically means the zone that liquidity exists in the market is about to be cleared. So an example of that is something like this. You've already gotten the reversal concept, you've gotten our inducement, you've gotten our POI. We've already marked out trendline liquidity for price to clear. The market is at the process of clearing the trendline liquidity, and you see people buying from a breaker block up here, or buying from an order block here, or buying from a breaker block here, or from an order block down here. As long as you've gotten a reversal concept and then you've marked out the draw on liquidity, which means the trend line liquidity is the draw on liquidity. As long as the market has not successfully cleared that trend line liquidity, don't try to oppose the market directions using points of interest that exist inside of that liquidity zone. Are you guys following what I'm saying? As long as you've analyzed the trade, you've gotten a reversal concept that tells you that this particular trend is ending and market is about to go to this other side. And for your take profit level, you are able to mark out the liquidity zone for that trade, which is your trend line liquidity. You've marked out the trend line liquidity, and then the market is at the process of clearing that trend line liquidity. It has not yet cleared it. You start looking for trades using points of interest that is inside of that trend line liquidity. You deserve to get stuffed out of the market. You deserve to blow your profit. You deserve to blow your live account. As long as market has not successfully taken out the draw on liquidity, for a particular trade that you're on. Do not try to oppose the market direction using points of interest that exist inside of that liquidity zone. That is one mistake that most people make. They analyze the market on the go every single time. Every candle tick, every candle movement they're on the chart. Every other block that they see on the chart, they will jump inside it. Ebuka. So now it's very important to understand the zones where liquidity lays in the market. That is why I'm teaching you guys these types of liquidity. So if you understand the types of liquidity, you'll be like, oh, this is trendline liquidity. And the market has given me a reversal concept that tells me that market is about to sell or market is about to buy. And for market to TP, it needs to clear this draw on liquidity by taking out this trendline liquidity here. All these other blocks I'm looking to buy are inside of this trendline liquidity. So there's no point looking for trades using those other blocks or breaker blocks. As long as the POI you're looking to take a trade from exists inside of a liquidity zone and that liquidity zone have not been cleared yet, don't try to trade using that POI. So with reversal concepts, it's easier to mark out take profit levels because there are previous structures that exist for you in the market. They are literally previous uptrends, previous downtrends. They can literally just take a trade and clear those ones. So it's easier to pick your take profit level for a reversal concept because when it happens, you can just target the previous structures that exist in the market and use that as your TP. For example, another example, you have this previous downtrend, right? When market gave us a reversal concept here and it became bullish, what did market do? It started buying until it cleared this previous structure of this downtrend all the way to where the trend line connected from and originated from up here. So with reversal concept, it's actually easier to pinpoint take profit levels because if market has been bullish previously and you get a reversal concept, just take a sell and target the zone that the bullish structure started from that you can literally connect with your trend line without much stress. So it's easier to trade reversal concepts and take your profit in the market using reversal concept because you can just target the previous structure. If this is the market movement, if this was the market movement, the market starts buying higher high, higher low, 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 and I get the reversal concept, get an inducement, and I get my point of interest here. For my take profit level, I can just draw out this trend line, the one that connects seamlessly, and then my TP will be aimed all the way to this low that the uptrend originated from. This will be my TP. Now, the mistake I will not make, let's not be like Ebuka FX. The mistake I will not make is coming here, seeing all these other blocks that exist inside of this trend line liquidity, and I will start looking for buys from them. This other block, this other block, this other block here, any POI that exists inside of this trend line liquidity is off limits. Do not try to buy or sell using points of interest that exist inside of a liquidity pool. Avoid it totally until price successfully takes out the liquidity. That's when market may eventually start buying to the upside. And before it starts buying again, you get the reversal concept. You guys, do you understand? So it's easier to trade reversal concepts because you can literally target the previous existing structures for your take profit level. It's easier to trade because you can target the previous existing structures for your reversal concept. This is the same thing here. You had this previous uptrend. Price hit a zone of for reversal, gave us an MSS, inducement, and then the other block here for our sell. Now, it's easy to pick up my take profit level. I just observe the previous structure of the market, look at the zone that the trend connects seamlessly, and I'll target the zone that the trend started from as my TP. So if I was selling, I will sell from the OB here, and my TP level would be all the way down here that the trend originated from. This is where my TP is going to be. Because that's the clear uptrend before the structure shifts happened. Now, also, I'm going to avoid looking for buys using points of interest that exist inside of the trend line liquidity. So the other block here, I will avoid looking for buys. The other block here, I will avoid looking for buys. The other block here, I will avoid looking for any POI that exists inside of this trend line liquidity, I'm going to avoid looking for trades using any of those points of interest until market successfully clears that trend line liquidity. That's when price started reversing back to the upside. So it's easier to trade TP levels using reversal concept because you can literally just target the zones of the previous structure as your TP in the market. It's easier to trade that because you can target the zones of the previous structures that exist in the market. Are you guys following me up? So it's always like that with reversal concept. The moment you get a reversal concept trade, mark out the trend line liquidity, basically mark out the previous structure of the previous trend, and then target the zone that connects seamlessly for your trend line liquidity, and then take your profit there. Easy. It's actually easy. So if market is on a particular trend, now this is for reversal concepts only. It only works for reversal concepts because it's only reversal concept that has to do with you changing directions of the previous trend. Now, when we're dealing with continuation concepts, it's a bit different, but it's still the same thing. When dealing with continuation concepts, is a bit different, but it's still the same thing. Two ways to use continuations. The first one is when the reversal concept TP has not yet hit, and you see continuation entry. This is what I mean. So let's say you have an uptrend, right? Market is giving you a series of higher high and higher low, higher high and higher low, higher high and higher low, higher high and higher low. Then you get a reversal concept, right? After that, you get an inducement. Then you get your POI. When market becomes bearish, it's going to do something like this. Keep selling. Do you understand? Keep selling. Then if you get a reversal concept, you get multiple breakout structure here. If you get an inducement, your POI will probably be somewhere around here. Right? Now, this scenario happens where market has not yet taken out this trend line liquidity yet. So you got the continuation entry before the trend line liquidity got taken out. That means it's actually easier for you to pick your take profit level for this continuation entry trade because you can literally just sell it to the next zone of this trend line liquidity being taken out. So it's easier when you trade continuation concepts with previous structures still existing in the market because you can still take this first trade, the TP for this reversal concept up here, you can still use it for the TP for this continuation entry here. But let's assume that you got the continuation entry, and then before price triggered your continuation entry, it's through this trend line liquidity here. How do you now take your profit in the market? You can no longer use this previous trend line liquidity for your TP because market already took out that previous TP before coming to now trigger this zone. So this is when you now have to rely on new structures being made for you to take your profit in the market using this continuation entry. Like I said, for reversal concept, it's easier because you can just target previous structures that exist in the market. For continuation entries, it's a bit more complex than, it's not hard, it's a bit more complex than the reversal concept trade because you have to rely on new structures being formed to take your profit in the market, which means you have to wait for market to form new structures before you can take your profit. But the same structures that we expected to form, you see the same type of liquidity. You can form trendline liquidity. Even if you're dealing with continuation entries, how do we get that? So you have to now watch out for the pattern that markets will exhibit before coming to approach your point of interest that you had marked out. So the difference between the reversal concept one and the continuation concept one is that with reversal concept, the TP level is already there before market even gives you your reversal concept. Because see, the TP level is where the trend originated from. So even before market gives you a reversal concept, inducement, and your POI, the TP is already existing. But for continuation entry, the TP will not exist until market gives you those your continuation concept, and then you now have to observe the pattern that market exhibits while approaching your POI. So the reversal concept trade, the TP level is already there even before we get the structure shift. But for the continuation entry, market needs to what? needs to have a POI present itself, then while approaching your point of interest, you now have to observe the pattern that market exhibits while approaching that point of interest. That is where your TP is going to be. This is one of the most common types of ways of taking your profit in the market, because most times we always trade continuation entries. You have to now observe the pattern that market gives you while approaching your point of interest. If market approaches your point of interest in a trend-like pattern, you can use that trend-like pattern as your trend line liquidity and still take your profit in the market. So let's say market starts trying to approach your point of interest and it does something like this. It starts doing higher high, higher low, higher high, higher low, higher high, higher low, and it triggers this sell zone that you have marked out. Notice how you can still use trend line liquidity here as our take profit level, but the difference between this reversal concept and continuation concept is that for reversal concept, the structure is already existing. For continuation concept, the structure got formed while market was approaching our sell point of interest. So the same way you use trend line liquidity, you can still keep your take profit level down here that the trend line originated from before your point of interest got triggered, which means if you take your sell from this zone, you can keep your take profit level at this zone. So that is the difference between reversal concept ways of taking profit and continuation ways of taking profit. When you trade reversal concept, there are already previous structures there. And if market gives you a continuation entry trade without the previous structure being taken out, you can still use that continuation entry and target the previous structure trade. See, this is what I mean. This is the first sell I have here, right? And the sell is all the way down to clear this trend line liquidity, right? Now, when we got the continuation entry, market have not yet cleared that trend line liquidity. So it's easier for me to target my TP because I can still target the zone of the previous trend line liquidity for this particular reversal concept structure. But let's just assume that market already took out that trend line liquidity. Where do I now place my TP? I will now have to rely on new structures being formed to take my profit, which is exactly what you see here. This is what your POI for this continuation entry. Now, the TP for this trend line equity has already been taken. So I have to now rely on new structures being formed to take my profit in the market. This is what the uptrend that market gave us while approaching this our POI. It means I can take my trade from there and then I will target that trend line liquidity for that particular trend, which is down here. So the two ways, the first one is what? For reversal concept, when you have previous structures existing in the market, you target the zone of those previous structure trends. If you get a continuation entry and then your reversal concept trade have not yet hit TP, you can still use that continuation and target that reversal concept trend line liquidity. But the moment that zone has been taken out, the moment that trend line liquidity has been taken out, and you're still looking for ways to hit your TP for that particular trade, you now have to focus on new structures being made while market is approaching your point of interest. Whichever pattern that market exhibits by approaching your point of interest, as long as it's a liquidity pattern, you can still take your profit in the market using that liquidity pattern. So that's the two ways. First one is the reversal, second one is the continuation. This is an example of the continuation one again. This is what an example of multiple breakout structure when price takes out this high, and all these highs here. The next thing we saw is a pullback and the candle wick down here, acting as an inducement for us for continuation entries, which is here. Then after that, the nearest point of interest is this breaker block here, which means we're looking for buys. Now, because there are no previous structures, okay, I can target this previous structure here for my TP, or I can pay attention to market giving me new structures while approaching my point of interest. So what do you observe? While approaching our point of interest, market starts giving us a series of lower high and lower low, 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 lower high and lower low. This was an example of a downtrend, meaning the market is exhibiting trend-like patterns. So you can take our profit in the market by observing the series of market move patterns that market is giving us while approaching our point of interest that we have marked out. It's giving us a series of downtrends, lower highs and lower lows, meaning that that's what trend line liquidity being accumulated on the upside of this chart here. That means for our take profit level, you can take our buy from this breaker block here and target that trend line liquidity that market is giving us while approaching our buy point of interest here. So the first method of taking your profit in the market is mostly for reversal concepts, which is you targeting the previous existing structures. The second method is for continuation entries, which is you targeting the new structures that market will create while approaching your point of interest. This is another one for continuation entries here. If you spot market giving you, taking out this high and then this high of the previous trend, giving us our inducement, our POI is this breaker block here. Now, for our TP, we are going to mark our TP while market approaches our point of interest. If you notice, while approaching the point of interest, it starts giving us a series of what? Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Triggers the POI. That means market was exhibiting trend-like patterns while approaching our point of interest. That means for my TP, I can target the structure of that trend that market was giving us while approaching our point of interest, which means I can target this trend line liquidity to be cleared for our TP level. So one of the patterns is the one for reversal concept, which means that you just have to target the previous structure of the previous trend of the market to get your TP. The second one is what? Continuation entries, which means you just have to target the new structures that market shows you while approaching your point of interest. There are the two ways to take your profit in the market using reversal concepts and continuation concepts. The first one is to observe the previous pattern of the market. When you get the reversal concept, you target the zone that the previous trend originated from. That is for reversal concept. For continuation concepts, the moment you've marked out your POI, you have to now observe the pattern that market approaches your point of interest in. Most of the times, it will always approach your point of interest in a trend-like pattern. If it does so, just target that trend and use the liquidity as your TP. Hope you guys are following me up, please. Also, it's skipping. Don't worry, the class is recorded, and I don't think the recording is going to skip. So this topic is very important. Trust me. Do you know why the topic is important? You need to avoid this thing of killing yourself. Do you know why? Killing yourself in a way that you are already a massive profit and then you end up losing the trade simply because you don't know where to properly place your take profits for your trade. You need to understand the zones where your take profit is supposed to be, because if not, you keep making money that you're giving back to your village people. So, depending on the pattern that market gives you, you can target your nearest draw on liquidity and be able to exit the market and leave the market depending on whatever market gives you. So, if you're looking for continuations, you just have to wait for market to approach your point of interest. Whichever pattern that market approaches your point of interest in, if it's a trend-like pattern, you will know where to put your TP. If it, we have these things that we call chart patterns. We have falling wedge patterns and rising wedge patterns. That's exactly what I'm trying to explain here. Falling wedge pattern is this lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Your TP will be to target the zone that the falling wedge pattern started from up here. That's your TP if you're looking for buys. Then if it's rising wedge patterns, if you have higher high, higher low, higher high, higher low, higher high, higher low, higher high, the moment market starts selling, your TP will be to target where the rising wedge pattern originated from, which is what? Down here. So we incorporate this to our points of interest. If it's a reversal concept, it's easier to target because all you have to do for a reversal concept is mark out the zone the reversal will come in, expect the reversal to happen, mark out your right point of interest, and target the zone, the previous structure of the previous trend. It's easy. It's easier. Then for continuation entry, you have to now do this. You have to now wait for market to give you new structures while approaching your point of interest. Let me give you another example of a reversal concept trade. I'll show you how we use the previous structures for our TP in the market. So let's say, sorry, there's a reversal concept trade that I took that I want to show you guys how I used the. Is my network lagging? I think my network is lagging here. I beg, this is not happen. I beg. The network is terrible this night. Don't worry. If the video is lagging, I will send another classes recording alongside this particular one as well. So this is it here. So this is it. You have market on a previous downtrend. This is an example of a reversal concept trade. You have market on a previous downtrend here, giving us a series of lower highs and lower lows. This is it. Lower high, lower low, 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 lower high. It kept happening until price came here and gave us a reversal concept by taking out this high. So we've gotten a reversal concept trade. We got our inducement by getting this valid pullback down here. And after that, we got the nearest point of interest by getting this POI right here. Now we've gotten that. The next thing in mind is what? Our take profit level. Because this is a reversal concept trade, all we have to do is to observe the previous trend of the market and then target the previous structure. So if you observe it, where did the trend originate from? That you can draw out without much struggle, without having to do much connection. This is it here. This previous downtrend. And the trend origination is up here. All you have to do is to buy until market takes out that high. That was exactly what market did. We bought all the way to this zone and market took out the high for our TP to be high. So you see, for reversal concept, it's easier because there are structures existing in the market. And once you get the reversal concept, you can just target that previous structure for your TP. But if it's continuation entry, you have to wait for market to give you more movement. Then from that movement that price gives you, you now map out your TP level. Do you guys understand what I mean? So reversal concept is quite easy. Once you get the reversal concept, just mark out the previous structure. If it's an uptrend, draw your trend line out. The one that connects without you having to stress the connection, target the zone that trend originated from. That's your TP for that trend shift. That's your TP for that trend shift. But if it's continuation entries, the moment you have the continuation entry, you have your point of interest. You have to just have all you need to do is just to be patient. While approaching your point of interest, market will do so in a liquidity pattern. Whichever pattern that market approaches your point of interest in will tell you where to place your TP. And most of the time, it always approaches your pattern, your TP level in trend-like patterns. What I mean by trend-like patterns, I mean uptrends and downtrend patterns. That's the pattern that market approaches your point of interest in. So with that, you can know where to place your TP levels for your trade. So that is one of the liquidity types that we have. That is trendline liquidity, one of the most common types of liquidity that exists in the market. Trendline liquidity, one of the most common types of liquidity that exists in the market. Trendline liquidity. So when you have market on a particular trend, then you get a reversal concept. With trendline liquidity, you can know where to place your TP level by targeting the previous zones of that previous structure of the market. It's easy. For continuation entries, once you have the continuation entry and you don't know where to place your TP, just wait for market to give you more structures. While approaching your point of interest, the structures it gives you will now take you to zones to place your TP levels for your trade. So that is how to take your profit in the market using trendline liquidity. Do you guys understand? And it's easy as well. And it's common. You know why it's common? Because market is mostly trending. If market moves from point A to point B, it is not going to magically appear there. It's going to trend. The market is going to move from, if gold is moving from 2,000 to 3,000, it has to be on an uptrend to be able to get from 2,000 to 3,000. That means if market should give me a reversal concept at 3,000, that means the market is going to sell. All I have to do is to target the previous structure of that uptrend. Then I will know where to place my TP based on that structure of the previous trend of the market. Don't worry. If the net, I think network is bad tonight, or maybe it's because of the location I'm in. But don't worry, it's recorded. Once I send the recording, I will try to send the previous class recording as well, so that you guys can have the ones that the network is a bit better also. Please bear with me this night. The network is a bit it fluctuates a bit this night. I'm also facing the issue here as well. Hope you guys are following me up. So we've talked about one of the types of liquidity we have in the market, which is trendline liquidity. Now let's talk about the other type of liquidity that we have in the market, which is mostly for ranging pairs, pairs that tend to range for a long period of time. It's called ranging liquidity. Now for trendline liquidity is mostly for volatile pairs because market is always mostly trending with these pairs. But the pairs that market tend to range with would range for a long period of time with. We mostly also have what you call ranging liquidity. Trendline liquidity is when market is trending. Ranging liquidity is when market is ranging. There are pairs like there's this pair NZD card where I saw this example because range does not really happen often. When market ranges is mostly due to lack of liquidity in the market. That's when market tends to range a lot. So when there's lack of liquidity in the market, you see a lot of range in the market. So that's we can still navigate our way through that in as much as we have ranging liquidity or trending markets. We can navigate our way through that to be able to take our profit in the market. So I want to make sure that you guys are well equipped for whichever type of market pattern that market is giving you, whether it's trending or it's ranging, you are well equipped to be able to take your profit in the market using ranging or trending liquidity. You guys notice what do you guys notice here? I was still able to take my profit in the market using trendline liquidity even for another pair. When market approaches zone, this is what trendline liquidity. I targeted the trend for my TP. When it approaches zone, trendline liquidity, I targeted this zone for my TP with trendline liquidity. Now let's talk about ranging liquidity. Ranging liquidity is basically the type of liquidity that you get when market is consolidating. Now, before you have a range, you have to understand that market already has a direction in mind. If market is ranging, before it starts ranging, there's already a direction in mind. So let's say if market is bearish and get like a structural shift, the market starts ranging, you will see the inducement, will start ranging. Now, a range can last typically sometimes a day, sometimes 2 days, sometimes 4 weeks, sometimes a full month, sometimes 2 months. But the thing is that when market is ranging, there's one thing that is doing. For trendline liquidity, when market is trending, it is accumulating liquidity on one side of the chart, which is the opposite side of the trend. But for ranging liquidity, it's not like that. For ranging liquidity, market is accumulating liquidity on both sides of the chart, both of them. The one on the upside and the one on the downside. So it's accumulating liquidity on both sides of the chart. The one on the upside is called buy side liquidity. The one on the downside is called sell side liquidity. So markets are accumulating liquidity on both sides of the chart while it's ranging. And the thing is that when market is ranging, there's only one thing it's preparing for. It's preparing for when it's going to stop the range and then start moving in one direction. The range is basically accumulating liquidity for more moves to happen in the market. Now, before we get to what we break out, this is what it's going to do. Whichever direction that your point of interest is, that's where market is going to break out first. And the thing with ranging liquidity is that it's going to take out liquidity on both sides of the chart. With trendline liquidity, it's going to just go for where the trendline liquidity is. But for ranging liquidity, it's not like that. For ranging liquidity, market will range until it takes out liquidity on one side of the chart first and then goes to take out the one on the opposite side of the chart. That's always the pattern of the range. So as market is ranging, the moment it prepares to move, before it will move, it will go up here and take out the liquidity on this upside first. Because market is bearish, it will take out the liquidity on the zone that the point of interest for the sell is. Once it takes it out, the next thing the market will do is to sell to not take out the other side of the range, which is this one, the downside. So that's how ranging liquidity works. So there's a pair. There's this happened one last. Like I said, the ranging for trendline liquidity, you get it more times, but for range, it's few times on the chart because markets ranges mostly when you had an impulsive move, and then market needs a little bit of kind of, how would I say, to just rest and accumulate more liquidity before more moves can happen on their side. Why is this not loading? The network this night is very terrible. I swear to God. And this is pissing me off, I swear. Are you guys following me up? Network is a bit very bad this night, but no worry. We are going to survive. It's not going to stop us from completing this sermon this night. So this is an example of it. So if you notice something, we had market give us an MSS inducement and it started ranging. For a long this range happened all the way from 6th May till June. That means for 2 months the range was happening. And this is a very, very sluggish pair. NZD card. Because that's actually the only place I saw ranging markets from. But it does not mean that that's the only time that you can see. You can also see ranging markets sometimes for the pairs that you guys trade. I mostly trade commodities and crypto and the rest. And that's why, because mine is more volatile. So I mostly do not experience ranging markets like that. But most people that trade currency, pure currency pairs, they mostly can attest to seeing this kind of range. So when you have a ranging market, you have market giving you a series of bounces from your support level to resistance level, bouncing from the one on the downside to the one on the upside for an extensive period of time. The moment the market is ready to move, it's going to go and take out the liquidity on the opposite side of the chart or where your point of interest is. So the moment market wants to move, the zone where our POI is this 4 hours order block here. Market is going to first of all go and take out that zone and trigger our POI. And once that zone is triggered, market is now going to go and aim for the other side of the liquidity by taking out the liquidity on the opposite side of the range, which is down here. Now, one thing I also advise you, like I advised you with trendline liquidity, is that when market is at the process of clearing trendline liquidity, do not try to oppose the market direction using points of interest that exist inside of the range. So, for example, if there's an order block here, an order block down here, or any POI that exists inside of this ranging market, do not try to start reversing the market direction using points of interest that exist inside of the range. Anything that you're going to look at should exist outside of this range if you can start looking for trades to reverse the market direction. Now, if I didn't know how to trade ranging markets, the moment price hits my TP, which is the nearest side of the range, I would have gotten stopped out if I did not take my profit at that level. Now, what the market do after hitting this TP zone, it came down here and then started buying to the upside. And if I was holding this position, I would have gotten stopped out by this move to the upside. So that's why it's good to know the zones where liquidity lays in the market, because if you know them, you can easily take your profit in the market without having market reverse on you. That's why I say you have to understand the different types of liquidity and how to navigate through those types of liquidity. Because if I had no idea on how to trade ranging markets, I would have gotten stopped out even after seeing 1:10 risk to reward ratio on this particular trade. I would have still gotten stopped out if you are greedy enough to hold the positions for longer. So I understood where not to get into the market and also understood where to also get out of the market. So you have to study the different types of liquidity in the market without much stress. Hope you guys are following me up. Now, that is the other type of liquidity, which is ranging liquidity. So you can take your profit in the market using trendline liquidity. That one is the most common type of liquidity, one of the most common types, which is trending liquidity, because market is mostly always trending. And the second type is called ranging liquidity. If you notice, trending liquidity is mostly common because market is mostly always trending. So you can take your profit using trendline liquidity basically anytime you want. Basically, anytime you want, you can use trendline liquidity for your TP level. I think you can even spot the trendline liquidity here now. This uptrend, the reversal concept, the inducement, and the market selling from this other block up here. And then for TP level, we targeted this trendline liquidity that we connected without much stress. This is the zone to target for your TP level. And market already hit that zone. I didn't bother connecting these ones because I can't really connect them seamlessly. So I have to connect the one that I can easily connect without much stress. See, same thing, trendline liquidity, and we're able to take our profit in the market. So trendline liquidity is very, very common, both with reversal concepts and both with continuation concepts. You can always take your profit in the market using trendline liquidity. Now, the moment you don't see trendline liquidity, you don't also see ranging liquidity, does not mean you cannot take your profit in the market. If you don't see trendline liquidity, you don't see ranging liquidity, you can also take your profit in the market using what we call um, external range and external range. I don't really know what is that. I think it's called it's called sell side liquidity range and buy side. Let me find out exactly what it's called. I've forgotten maybe because I wrote it down somewhere. Let me remember. I'm coming. Just wait, give me a little bit of time. I'm coming. It's basically buy side and sell side liquidity. But what I mean by that is that basically the last swing high or the last swing low that market gives you before your point of interest gets triggered. This is what I mean. If you have something like this, let's say you have, and it's mostly for continuation, and let's say you have something like this, um, you have market give you multiple break of structure, inducement, then market pushes up. It keeps buying to the upside and keeps buying more, then it gives you this high before pushing back down to come trigger your point of interest that exists down here. What I mean by the last swing high before your point of interest gets triggered, it basically means the last possible peak of a high that you get in the market before price came down to trigger your point of interest. You can take your profit in the market using this high. Same thing for the low. If this is a multiple break of structure and it's an inducement, and your point of interest is here, the last possible peak of a low that you see in the market before your point of interest gets triggered is the swing low. So the market does something like this, then it does something like this. The last peak of the low you see is here, which means eventually when market triggers your point of interest, the first one is that low for your TP. So I will show you guys an example of this with Bitcoin that we traded last week or last week, I don't know. Notice how for each time that market starts buying, because it was an uptrend, the nearest zone that market will get to first before it gives me any retracement is always the last external high that market presented itself with before our point of interest got triggered. Let me on the net on my network they won't me for this place. I swear to God, this is pissing me off. I swear. But don't worry. Oh God. Why is this happening to me now? Okay. Sorry. Now, this is what I mean. The last peak of any high before your point of interest gets triggered in this scenario is this zone. This was the last peak of this high before price triggered our point of interest, and my TP targeted that high. Now, I could not see trendline equity properly here, so I used that swing high as my TP. Same thing here. The last swing high that exists is here before price triggered this point of interest. This other block here for a buy. That means my TP will be aimed at that zone and I will exit. The last swing high that exists before price triggered this other block here is this zone. That means if I buy from here, I will buy until market takes out that high. This is the nearest draw on liquidity that works every time, except you're trading in the wrong direction. As long as you're trading in the right direction, the POI that market gives you, the last swing high or the last swing low that market presents itself with before triggering that point of interest, you can always use that as your TP level. It works every time. You can always use that as your what? The TP level. This is another example. Like this is the last swing high before price came down to trigger this point of interest, right? When market started buying, what was the first place it went to before market started selling? Took out that swing high before price started selling. So it's very important to know the last swing high of your setup. So whichever high that picked the particular zone that you want to take your trade from, that high or the low can be used as your TP level. and it's the nearest view on liquidity as well. Market will always go there first before any more moves will happen. And market may always exceed that zone, but the first place is going to head to is that zone. If you have something like this, and you have market give you multiple break of structure, give you your inducement, then push up here and you see something like this. As it triggers this point of interest, your TP level would be the last swing high that price gave you before price approached your point of interest. So your TP will be up here. And it most times it will always exceed those zones. But just to be safe, this has a higher win rate than you mapping out your TP to extend past that zone. Because most times market can just do this, take out the high, and then you see it start selling down. But it has already hit the nearest drawn liquidity. So it's very important to understand the different types of liquidity that market has and to know how to properly place your take profit level using those types of liquidity. So far I've mentioned trend line liquidity, which is the uptrend and the downtrend. I mentioned how to take your profit using the trend line liquidity for the ranging market for the reversal concept, which basically means to target the previous structure of the previous trend, right? The one that connects seamlessly without you having to stress it. That is the first that is the trend line liquidity. Then for the one for the continuation entries, you just have to pay attention to the pattern of the structure the market is giving you while approaching the point of interest. If you pay attention to that pattern, if it approaches your point of interest in a trend-like pattern, you can target the zone that that trend line liquidity originated from as a TP. That's how you can use continuation entries and reversal entries for trend line liquidity. Secondly, I talked about ranging liquidity. I mentioned that while ranging, market accumulates liquidity on both sides of the chart, the buy side liquidity and the sell side liquidity. So when market is ready to move, it will take out the liquidity that protects the point of interest first. Once it takes it out, it will go to the other side of the range. That's how you take your profit in the market for ranging liquidity. Thirdly, I now mentioned the external range and the internal range liquidity. Yeah, that's what it's called, external range liquidity and internal range liquidity. I don't really generalize classify it like that. I just call it the last swing point before your point of interest gets triggered. So you can use all these methods for your take profit level. And there's no way on God's green earth that you are going to analyze your setups and you apply these concepts for your TP that you're not going to see the actual zone where your TP is going to be. Most times when we get greedy, you notice on the chart before markets we will let's say you have your traders 1 is to 10 or 1 is to 11. I don't focus on for my TP. There's always a reason for my TP. I don't just take my trades like that without having a reason for where I place my take profit. So my focus is not even on the risk to reward. My focus is on the zones where liquidity lays in the market. So if my liquidity zone is 1 is to 5, I can take the trade. If it's 1 is to 4, I can take the trade. If 1 is to 20, I will take it. As long as the setup I have, based on technical analysis, this is where my TP is supposed to be. That's where I'm going to place my TP. I don't care about the risk to reward. My focus is what? The zone that liquidity is supposed to be on. So with that, I can now target my take profit level for that particular trade. So all these things I mentioned for you guys, um, you can use it to you can backtest, forward test, check every single trade that have happened previously. These are how we picked our take profit level for those trades. The one of this external high that I talked about, the last swing high, the last high that market presents itself with, or the last low that market presents itself with before your point of interest gets triggered, is the one that works the most because that is the first initial place that market will want to go to first before any move will happen in the market. That's the first place that price will head to. That's the first place that price will head to. So these are the types of liquidity that we have in the market, and this is also how we take our profit in the market using those types of liquidity. So hope you guys understood this particular session. Um, our next class will be on directional bias. After that, we'll now have our question and answer session because I know you guys have a lot of questions. So after the directional bias class, I'll give you guys about 3 days, 5 days, or a week to go through every recording, compile everything, and bring out your questions. Then you can now have the question session where we're going to answer all those questions that you have. So I hope you guys enjoyed the session, and I'll see you guys on, I think, on Monday next week.